CAVA's full-year margin guidance sits more than a full point below what they just posted year to date, and that gap is the single biggest tell in this whole report. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. CAVA gets graded and traded. So on the headline, revenue came in about 1.9% ahead of estimates, up 31% year over year to $365 million. That's a solid top-line beat with real growth behind it. And EPS came in about 5.5% ahead of the street. Not a monster beat, but a clean one paired with the revenue. So on the beat itself, this earns a C. The beat is real, but it's a modest one on both lines. Not the kind of blowout that reshapes the story. And on consistency, this earns a B. CAVA has a solid track record of beating quarter after quarter, and this print keeps that streak going. Let's talk about the positives from the report. Revenue jumped 31% year over year to $365 million, and same restaurant sales were up 9%. That's a strong number in this environment, full stop. And here's the part I really care about. Of that 9% comp, 5.3 points came from guest traffic, actual bodies walking through the door, not price hikes. That's the highest quality form of restaurant growth you can have. On the unit side, they opened 17 net new restaurants in the quarter, bringing the total to 476. That's almost 20% year-over-year unit growth, and management said new stores are outperforming expectations. The balance sheet also got stronger. Cash and investments now sit at $435 million, up from $323 million at the end of last year. That means they can fund all this unit growth themselves without raising money. And management reaffirmed the full-year guidance across all 5 metrics: new openings, comps, margins, EBITDA, all held. After posting 9% comps in the quarter, they've got real cushion against the low end. So on profitability, this earns a B. Restaurant-level profit and adjusted EBITDA both grew about 30%, which is great in dollars. But the margin percentage actually compressed 60 basis points, and that's what keeps this from being a higher grade. Now let's talk about the negatives from the report. Restaurant-level profit margin compressed 60 basis points year over year to 25.7%. That came from the salmon launch input costs, more third-party delivery in the mix, and wage investments. And the delivery mix piece is structural, not one time. Both restaurant cost lines moved the wrong direction. Food, beverage, and packaging went from 29.5% of revenue to 30%. Labor went from 25 to 25.3. Dollar profit still grew, but the margin trend is now flat to down instead of expanding. Same restaurant sales also decelerated a bit, from 9.7% in the first quarter down to 9% here, and the full year guide of 4.5% to 6.5% implies a meaningful step down in the back half. The effective tax rate also jumped meaningfully, roughly 24.7% this quarter versus 22.5% a year ago. That's driven by a smaller tax benefit from equity comp, and it's going to keep net income growth trailing pre-tax growth going forward. And here's the one that matters most. The full-year restaurant margin guide is 23.7 to 24.3%, but they just posted 25.7 and they're at 25.3 year to date. That gap tells you management expects real margin compression in the second half that hasn't shown up yet. On guidance, this lands at a B. They reaffirmed all 5 metrics after posting 9% comps, which gives them real cushion to the low end. It's not a raise, but reaffirming a strong bar after a strong quarter is a positive signal. And on red flags, I'm at a C. That gap between the margin guide and what they've actually posted year to date is the single biggest forward risk in this print, and the market has paid a premium for CAVA, specifically because of the margin expansion story. If that unwinds in the second half, the stock reprices. Putting it all together, this was a strong operational quarter with a real question mark sitting right underneath it. The traffic-driven comps, the unit growth, the reaffirmed guidance, all bullish. But the margin guide for the back half sits well below what they've actually posted year to date, and that's the piece the market hasn't priced in yet. So I'm giving this print a B-. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. For me, selling cash secured puts is way more attractive than just buying the shares outright right now. The 9% comp and the reaffirmed outlook tell me the story is real, but I want to get paid to wait. I'm looking at strikes 12 to 18% below where the stock is trading. That gives me room for a pullback if the second half margin questions actually spook the market before third quarter earnings. 30 to 45 days out is my sweet spot. That captures the elevated implied volatility after this print, and it lines up with a window where a margin-driven dip could realistically show up. So for me, cash secured puts beat buying the shares here. My strike floor has to survive a third quarter print, where restaurant margins actually step down into that 23.7 to 24.3% range, and the market reprices the stock lower. That means I'm going at least 15% out of the money, and honestly, I'd rather go further. I want a real buffer, not just a comfortable one. If I sell anything closer to the money, it's only at a price where I'd genuinely be thrilled to own the shares, given the 19.6% unit growth and the self-funded balance sheet. So my strike floor has to survive that margin step down. I'm holding. The 5.3% guest growth is traffic-driven. 17 new openings outperformed, and management reaffirmed the full-year outlook across all 5 metrics. That's my ownership thesis intact. The only reason I'd trim a piece of my position is if shares rip on this print without acknowledging that guided second-half margin step-down. That's an unresolved risk, and the market could reprice the stock on it later. And if I want to add, I'm waiting for post-earnings weakness. I'm not chasing strength into a setup where third quarter margins might disappoint. So I'm holding my shares here. If my strikes get threatened, I'm rolling up and out. 31.3% revenue growth and a reaffirmed outlook mean I don't want to give my shares away cheaply. The margin outlook implying second half compression actually gives me cover to sell calls 10 to 15% above current price, with 45 to 60 days to expiration. That's my comfort zone. What I'm avoiding is short-dated at-the-money calls. The unit growth momentum could still generate an upside surprise, and I don't want to cap myself right at the money on a short leash. So if my strikes get threatened, I roll up and out. I'm holding my leaps. Nothing in this release breaks my 12 to 24-month thesis. Unit count grew 19.6% to 476, and new openings are outperforming. The balance sheet has $435.6 million in cash and investments to self-fund growth, and full-year unit guidance of 75 to 77 openings got reaffirmed. That's everything I want to see. The only time I'd take profits is if shares rally hard into the third quarter print without the market acknowledging that margin step-down risk. Then I'd trim into an unearned move. So I'm holding my long-dated calls here. This release validates the original bull thesis on the two things that matter most for a multi-quarter hold: traffic-driven comps at 5.3% and unit growth with 17 net new openings, and the outlook reaffirmed at 75 to 77 for the year. So averaging down is defensible for me on weakness. If a third quarter margin scare drives shares lower, that's the kind of setup where I'd add to my position, not panic out of it. The underlying story here is unit economics and portability, not near-term margin optimization. A cut-loss framing just doesn't apply based on what this release showed. So averaging down is defensible on weakness. Bottom line, this print earns a B- from me. The traffic-driven growth and unit story are still intact, but that second half margin guide is the one thing I'll be watching closely into the next report. Thanks for watching, and I'll see you on the next one.